is David Vella, a partner with Allen Partners. I'm going to hand over to him to introduce his panellists.
Thanks, Tim. So thank you all for this afternoon. So actually in the second session, Rune asked the question about ESG and impact. Will it be in every portfolio? So this afternoon, this session, we're going to be talking about transitioning portfolios with carbon emissions. So maybe we'll just start off with the panellists just giving themselves a quick introduction. So Natasha.
Hi everyone, I'm Natasha Morris. I'm the Managing Director of Responsibility and Impact at mid-market private equity firm Adamantium Capital. And even though my title has words in it that are not ESG, it most definitely includes all aspects of ESG that we'll be talking about today.
Hi everyone, I'm Prins. I'm the co-founder and CEO at Pathzero. We provide a carbon management platform specifically for private equity and venture capital businesses.
Hi everyone, Suzanne Tavel. I'm a partner and global head of responsible investment for Stepstone Group. So that covers off all our ESG as well as impact activities.
Good afternoon, everyone. I'm Greg Wasserman. I head the private climate investing team at Wellington. And so we invest in growth stage companies that are developing climate solutions.
So to start, we might just start with Carl. You're a bit of a numbers person. So when we're talking about working towards net zero by 2050, what does this really mean? What are we working towards?
Well, in the recent IPCC report, AR6, I think the easiest way to think about it is the budget of carbon that we have over the next 30 years. And this puts it between sort of 300 to 500, let's call it 400 gigatons of CO2 specifically that we have left to emit if we're to achieve a 1.5 degree scenario, most likely about 2/3 probability. So if you think about the run rate today, it's 40 gigatons, so it gives us 10 years. So we've got 10 years left at the current pace, and we need to get to 30 years. That's a little bit alarming if you think about us still actually achieving 1.5 degrees, and it's probably most likely now that that's not really in the realm of probability. Pushing it a little bit out to get to about 1.7 degrees, it's probably about 17 and a half years of current run rate left. We all know about burn rate in this room, and we need to stretch that over 30 years. So the picture that's become clear is the rate of descent of where we are today, this 40 gigatons, and the delay in policy and action that we've had just means that curve becomes steeper and steeper and steeper as we approach probably 2050. So there is an alarming rate of change required between now and 2050 to get anywhere near the Paris Agreement.
So with the net zero target, so what kind of conversations are the GPs having with their LPs at the moment, Natasha?
I think it's fair to say that the conversations have evolved a lot over the last few years. To give an interesting data point to reference that, when we first did the carbon footprinting across our portfolio companies 3 years ago, we were doing that for our own internal data-driven reasons. It wasn't really something that we got a lot of requests for from our LP base. Today we get a lot of direct bespoke requests around carbon footprinting data across our portfolio. But I think for me the really interesting way that conversation is evolving between LPs and GPs is we're moving a little bit beyond the data collection point. And certainly our conversations are a lot more about how are you using that data to make better investment decisions and be better stewards of capital. So we're having quite detailed conversations with quite a lot of our GPs around what are you doing in the pre-investment phase to understand the decarbonisation profile of these assets that you're looking to invest in. So are you looking to estimate their Scope 1 and Scope 2 emissions during due diligence? And then if you are, how are you factoring in whether you can decarbonise that asset over what period of time? What's it likely to cost? What's the likely impact if we do impose some kind of carbon pricing on that? Equally, what's the kind of dynamics of the market that that asset is operating in. So is it more relatively carbon intense than its main competitors? And what will that do over the next 3 years as we transition to a low carbon economy? Does it export a lot of its products to overseas markets that are considering imposing carbon border adjustment taxes? And if that does come in during your hold period, what does that do to the revenue from your exports? So having a lot of those conversations around understanding what the carbon profile is of the asset, but more importantly, how is that driving better risk assessment in your investment decision-making process and a better investment decision? And equally, we're seeing that flow through into the ownership period. So how are you then, once you're owning this asset, what are you doing to try and create value through your approach to decarbonisation? And we're seeing that come through quite strongly, particularly in our businesses that have corporate customers or government customers who themselves are setting really strong net zero targets even across their value chain emissions. If our businesses aren't decarbonising and aren't able to meet that demand, that impacts kind of your customer retention and your customer growth. Equally, we had a really great conversation in an LP forum the other day around one of our businesses and how are we integrating its net zero plan into our CapEx decision making. So if you're investing in CapEx, it's going to have a long useful life, but it's highly carbon intense because there's no alternative at the moment. How are you factoring that into your investment, into your decision making during your hold period so you're not leaving yourself exposed? And so what I'm actually finding is that conversation is evolving beyond just the concept of decarbonisation, but actually how is it infecting your investment decisions? And it's very collaborative. I say a lot of those things. We don't always have the answers to all of those things, and I think there's an increasing recognition from both LPs and GPs that we're all on the same journey here. We're all trying to achieve the same outcome, but we're all facing the same challenges. So, for example, on our latest fund, we've got an emissions reduction committee that is made up of a group of our LP investor base that is helping to guide us on our decarbonisation journey. And I think the LPs are learning a lot from our approach. We're definitely benefiting from the shared learning that's helping us to understand the LP perspective and what other people are doing. So I think the conversation is also becoming more collaborative.
Yep. Okay. Greg, you got any thoughts?
Yeah, I would echo all of that, and I would say you see it permeate between the LP and GP discussion, in different degrees, right? A lot of LPs are feeling pressure from some of their constituents on sustainability and pressure on net zero and caring about ESG. And so on the one hand, you see some GPs kind of responding to that and saying, okay, now I need to think about net zero. I need to push that across my portfolio. I need to start reporting on ESG because my LPs want that. So there's definitely a lot of that happening in the market. I think there's also a lot of realization on the commercial opportunity. We look at it and say climate change is literally an existential threat to society. And because of that, it's actually one of the largest economic opportunities we will see. And so it's very much not pressure to feel like we have to respond to it, but it's actually a pretty incredible investment opportunity. And I think the same thing is true for ESG, right? It's not just a tick the box thing that your investors care about, and so you have to give a report to them every year. But people are realizing that ESG is actually not an asset class, but it's a lens of risk that you can apply to any investing that you do. And if you actually have a thoughtful ESG lens in whatever asset class you invest in, you're identifying risk and opportunity with company culture and how they behave environmentally and governance and all these issues that really in the end all affect alpha and return. And so I think people are really starting to realize this, and you're seeing that kind of permeate the discussions.
Suzanne, you talked to both GPs and LPs, both domestically and probably internationally as well. How are you seeing the approaches differ between GPs and LPs? And also then, are Australians ahead of the pack or are we behind the pack?
Thanks, David. So I think let's separate out the GP discussion first. So where I think the discussion is moving to is first around relevance. So I think for a long, long time, most mainstream GPs have heard the word decarbonisation, interpreted that as energy transition, and interpreted that as renewables. And so basically they were like, well, if we're not investing in renewables, it's not really directly relevant to us. And I think what has started to develop is that understanding that decarbonisation is about adjusting every single aspect of our entire economy and what we do. So it does apply to software businesses. It does apply, to services businesses. And everyone has to think really hard about their supply chains, where they're locating people, et cetera, et cetera. And so that understanding of relevance, I think that shift is starting to happen. Now, obviously, you've heard from Natasha. Adamantium's a lot more progressed and further down that path than, by and large, a lot of GPs, frankly, are globally. We certainly see that European GPs are arguably, if you take averages, probably ahead on this journey. Obviously, a lot of that is the very, very ambitious regulatory frameworks that they're operating under. The other noticeable shift, I would say, that we've seen on the GP side is decarbonisation for quite a while has been siloed as a subset of ESG, which in turn has also been siloed to someone's part-time role, potentially maybe compliance or IR, right? And suddenly there's the recognition that, whoa, this is like a really deep, wide space with lots to wrap your head around, and it's moving to warrant dedicated personnel. It's certainly moving to warrant dedicated resources. But more importantly than any of that, in my mind, is the fact that we're starting to see managing partners of GPs really wrapping their heads around it and becoming fluent in talking about decarbonisation. And that's really important because I think as anyone starts to have this discussion, you realise the complexity, you realise the breadth, you realise what you thought you were doing actually was just really tip of an iceberg. And as you get into it, there's so much more to be done. So that's the GP side. The LP side, I think, really has been the issue of LPs have made a lot of commitments. The Net Zero Asset Owners Alliance has received a lot of support globally, including from a number of domestic asset owners. There's a certain time period, and then you have to report under that. So the big pressure is to get out the reporting. And for that, they need the data from their private markets, and that certainly is a point of challenge. So, how they're investing, the development of their programs, and, thinking about building exposures around decarbonisation is following many, many paths. Again, the Europeans arguably are leading in terms of some of the sophistication of that.
Natasha, so you talked about your emission reduction committee. How are you actually approaching, how's your experience been in measuring your portfolio and ensuring the accuracy of your data?
I'll choose my words carefully. I'm going to say varied. Another word could be roller coaster. It really depends, and I think we all need to be really alive and transparent about that. We have a bunch of different portfolio companies that operate in different industries, in different sectors, with different degrees of sophistication around their systems and processes. So our experience has ranged all the way from, a very well systematized business that measures every ounce of energy used within that business in a very high performing platform, and it spits out the greenhouse gas emissions data. That is absolutely the exception and not the rule. At the other end of the spectrum, we have businesses that are widely geographically dispersed, that collect their energy usage data on a site-by-site basis, and I'm talking kind of upwards of 60 sites here. And so trying to collate all of that data to get a robust footprint of that business was a challenge. And I think, we've had to be creative in the way we do some of that. So to do that as a full process based on complete data is a multi-year process. So you can develop approaches to applying robust assumptions and estimates alongside a plan of actually improving the data quality over a certain period of time, so your level of estimation decreases year on year. It depends a lot on the skill set in the portfolio companies. This is not a reflex a lot of Australian corporate leaders have, because we haven't had to, and it's only really entering mainstream corporate Australian discussions over the last little while. So we've really had to kind of support on that journey as well. It's generally not something you can just flick to a portfolio company and say, please get that back to me next week. It does require a lot of support. But I think the other thing that's helping, it's actually in equal parts helpful and unhelpful actually, is the myriad of frameworks and standards that are being released around how you should be measuring your carbon footprint and how you should be disclosing on climate risk and how you should be integrating that into your financial statements, is unhelpful because there's so many of them, it's hard to know which one to choose. It's helpful in the sense that we're at the stage where we are starting to see some of those emerge as the front runners in that. And there's a lot of really good work going on in the private capital industry, particularly overseas, to take some of those frameworks and standards and tailor them specifically for the private capital industry. So that there's a lot of good work by an organisation called ICI in Europe, in the UK, that's doing some really good work, which makes it easier, which makes this data collection process easier because it gives you some frameworks. So my view on this is you've got to start somewhere, and you can't let perfect be the enemy of progress in this stuff. So the most important thing as you're going along that journey is being transparent about where it is complete and accurate and where you are making estimates and what you're doing to improve that.
Greg, maybe it's hard to improve when we can't measure things. So, you're looking at options out there. You're seeing many options or solutions for asset managers to help work on this emissions?
We are. We always say it's very hard to reduce if you don't know where you are. Like the analogy I like to give is if someone's trying to lose weight, if you don't have a scale, you don't actually know what you weighed and if you're actually losing weight or not, and if your diet's working. And so you really have to track a baseline and then calculate from there to figure out where you're going and if you're actually reducing or not. And it becomes infinitely more complicated when you're an asset manager with a portfolio of companies, because each company, especially on the private side, which is where I focus, many of them don't measure. We encourage them to, and work with them to go in that direction. But they're all sort of on different degrees of that journey, and they're all calculating things different ways. And so now, if you have a portfolio of 20 companies or 100 companies that are all at different stages calculating things differently, the answers we get are pretty inconsistent. And then for investors that are investors in us, when they want to compare us to another portfolio and they need to report back to their LPs, you just have all this inconsistency across the board. And so something we're seeing that we're pretty excited about is a number of technology platforms popping up to really start automating and standardizing some of that measurement. And so we actually have a software platform that we're going to be giving to our portfolio companies so that they can all automate their collection, and it's all standardized back to us. It makes it easy for them, easy for us, and then easier, eventually for our investors to be able to track across their portfolios. And, part of what is painful about this, we talked about data collection, that's the really hard part for these portfolio companies. And, there's really interesting innovation happening where you can automate the data collection and automate the calculations, which really makes this much easier to do. For many companies, the biggest chunks of their emissions come from their utility bills, their people, their travel, their supply chain. And so if you can start using APIs on the software side to plug into your existing systems, you can automate that collection. Many utilities have APIs where you can plug in and pull your utility bill digitally. And so all of a sudden you can automate that piece. You might have a travel system or an ERP system where instead of somebody having to manually upload every flight that you've taken, you can just automatically pull it. And you can know what points you traveled, calculate the carbon off that automatically. And we're just starting to see this roll up into the supply chain side, where you can see your suppliers, what items you've purchased from them, what path they might have taken to get to you, whether it took ship or boat, and how it actually, the path and where it got to you, and you can calculate that. And so I think it's pretty exciting seeing some of the innovation that really just makes this much easier and simpler and therefore a bit more consistent across the board.
Carl, you are actually one of these solutions as well, Pathzero. So you're actually in the measuring and reporting of carbon emissions. So what do you see the role of technology in assisting in this reporting and measuring of it, and what kind of experiences are you seeing from different managers?
I think Greg has articulated that pretty well, partly already, but I think just thinking about it in bigger terms, there's so many people who have this expertise in the world today, boutique consultancies and others who provide these services. And then there's every company in the world that needs to start reporting this the same way they report their financial information. So we definitely need a technology solution, otherwise we're simply not going to be able to scale the expertise that we need in order for us to actually do this. The second thing that's really interesting about this particular problem is the collaboration aspect that's required. People talk about radical collaboration, new conversations happening between parties in a supply chain or in a capital structure like this, and how do you work with companies that you're invested in at varying levels of influence in those particular companies, from listed all the way through to, wholly owned, and what is the appropriate level of engagement that needs to happen. And technology has a role to play, obviously, in solving both of those solutions, but thinking about the issue there, I think in terms of collaboration, working out what is the right level of engagement is really important. There is an initial, you could go to every single company and do this perfectly everywhere on day one, but what we're seeing is a smart approach that a lot of managers are taking, is to say, well, on a sort of a desktop analysis, data-driven, top-down approach, what can we glean from where we are sitting today in preparation for more rigorous reporting? How do we identify the companies that we're invested in that are in a sector that has a difficult decarbonisation route, or that is producing a particular gas that itself will be really difficult to abate? And how do we then have very pinpoint conversations in our supply chain to have really high-value data brought back to us? This data is sensitive, it is confidential, it needs to be very secure. You can't necessarily just pass that around in spreadsheets and hope that emails don't get intercepted, for example. So again, technology has a role to provide a communications network that's able to transmit this very secure data between players in the appropriate way to the appropriate person for the appropriate calculation. So removing the human element from that is actually probably a necessity in actually enabling that collaboration between parties.
I think, the other thing I would add that technology adds to that process is the real-timeness of it, because this stuff is not set and forget. You don't measure your carbon footprint once and then forget about it. You measure it once, you try and reduce it, you get back on the scales. And so the technology solution enables you in real time to be able to see things. In the same time, you real-time track a lot of other KPIs across financial indicators in the companies that we all manage. This is going to be something that we're starting to look at on more than a once every 12 or 24-month basis. So technology solutions that give access to all the stakeholders to that, I think, is an important part of what the technology solution offers.
Thank you. Yeah, and just again, to that point, also being able to actually tie in those actions that are being taken back to the model that calculates the greenhouse gas emissions, back to the trajectory that your portfolio is actually on, is so important to couple those actions together. So when you're saying that you're Paris aligned or that you're on a particular glide path, you can actually evidence that through the calculations, and you can point at the specific initiatives and programs that are in place to effect that change.
Yeah, and that's the thing. I suppose we all have carbon emissions, we can't deny it. And so it's more about how we actually work to improve our portfolios and that measurement ongoing and glide path. So, we've talked about collaboration. Can we maybe just kind of expand a bit more? We're mainly PE investors and things here. What can the alternate investment community kind of help? How can we help drive decarbonisation? And is net zero enough, or should it be about gross zero as well? Do you want to start and we'll work way down?
Yeah, I think this is a really important point. Everyone talks about net zero, and I think that's a great goal to aspire to, at least for a starting point, which is where the world is right now on, their journeys on emissions reductions. But reality is net zero is really not ideal, right? Any company could be net zero today, right? You can run some quick back of the envelope math, you can figure out what your carbon footprint is, and you can go online and you can buy a bunch of carbon credits, and suddenly you're net zero, and that's great. But reality is you haven't actually done anything for your footprint. And so I kind of like to think about it with this concept of gross zero, or really just reduce as much as you possibly can operationally. It's very, very hard to get to gross zero truly on a full basis. And so reduce what you practically can, and then buy some offsets for the rest. And, obviously that's a journey, and different companies will go down different paths, but I do think it's really important for people to not overly rely on offsets, partially because that's not the eventual goal, because you do have to reduce your emissions anyway, but also if everybody starts relying on offsets, the price of offsets will go through the roof, and now if you want to get to net zero, now you actually have to reduce directly anyway. So I think that's a really important point that many people lose a little bit in the discussion around net zero, but is really critical for the goal of what we're trying to actually get to around decarbonization.
Yeah, I think this gets to the crux of why this is potentially one of the biggest investment opportunities facing private markets and private equity in particular, is that private equity has the toolkit, right? They know how to work with businesses, they know how to change behaviors in businesses, and this is what we're talking about. We're talking about changing the behavior in every single aspect, literally, of a business's model and operation. And, private equity, it has the opportunity to tilt and adjust some of that toolkit. If we think about the idea of incentives, adjusting management incentives in a way that is going to align to a program of reduced emissions, it will happen. I mean, and, already we can see incredible results that GPs have got just starting to experiment with how to incorporate incentive adjustments at various levels within an asset's executive management, all the way down to the shop floor. And it's amazing when you start to measure it, when you start to incentivize it, it does get done. So I think this is really the crux of the opportunity, and it's an incredibly important point. Like, ultimately, if people don't get ahead of this, and there's a reliance on offset, and prices go up, then you're behind, because then you're trying to catch up and make all these adjustments at an operational level, which takes time. And at the same time, you're going to be faced with a really, really, really expensive offset bill, which is probably oversized with what it should be.
And I would just throw in, related to that, companies that were proactive about shifting their electricity usage to renewables probably look pretty smart right now, given what's happened with electricity prices. And so it really does tie into, business performance and ultimately profitability, which I think is, the ultimate goal of how you really get this done.
Yeah, so I believe the objective is to increase the value of the company you're invested in. And having this additional layer of information regarding this macro trend is certainly a way that you can add a lot of value to your portfolio companies as you prepare to move them on to the next stage of their growth. So simply being informed about this and helping them understand how they would be impacted sector-specific, gas-specific, company-specific level is a huge value add. On the flip side, the big question about net zero, I think that will play out, is how big is the net in the net zero? If you look at science-based targets initiatives, it might be that we're going to gross reduce to 10% of where we are today, and that all those offsets are going to be carbon removal, and that's how it's going to play out. We may find that the scenario ends up that we are 60% offsetting what our emissions are today in terms of the net opportunity. So looking at the solutions that are actually going to create those credits, which really looks through to processes that decarbonize. If you have a technology that can be plugged into an industrial process and decarbonize it, that's going to be a very valuable business over the next 30 years. So being able to assess where those opportunities are and looking for those growth companies in this particular environment, I believe if you're well informed, it just gives you the additional layer of information you need for a better investment.
Thanks, Carl. The benefit of going last is I get to pick up on all of those points. And I would agree with everything they said. To start with something that Suzanne said, I do think that the benefit, certainly in the position that we're in, which is a controlled private equity investor, is what we really bring to the table is influence. And so we can really put decarbonisation and other elements of ESG, as Greg referred to earlier, centre of board discussions, centre of management considerations. We can incentivise them in a way that a lot of other investors don't have the ability to do. And when you kind of put that alongside the size of the part of the Australian economy that private equity touches, which is large, we have a real ability in this alternative investment space to drive decarbonisation across the Australian economy. I think the other benefit that we bring to the table, because we manage portfolios of assets, is actually a knowledge sharing function here. And we look at it as efficiency across our portfolio, frankly. One thing, we spent 12 months last year developing a net zero plan for our most emissions intense business. And it was a long, hard slog. It has a lot of really hard to abate challenges in it. But we were able to use a lot of that learning into a net zero plan that we're doing for another business of ours, which is in a completely different industry and sector, but has a lot of the same challenges. So being able to share that knowledge effectively across different industries and sectors is also one of the things that the private equity sector brings to the table. I think to pick up on something that Carl mentioned, one of the things that's definitely front of mind for us when we're looking at decarbonisation of these businesses is it really comes very strongly into your exit discussions. So who are you planning to exit to? If you're planning to exit to a European strategic, for example, to the point before, they probably have really ambitious net zero targets in place because of the regulatory environment they're operating in. So you roll forward 3 to 5 years from now and you're trying to sell them a business that's really carbon intense because you've done nothing about it, that could be an interesting position. And I think, finally, to pick up on Greg's point, I think the ability we also have to influence, we like to look at the different levers that you can pull to decarbonise a business, as starting with what we kind of call more like behaviour change. We call it the equivalent of telling your kids to turn the lights off when they leave the room. It's what can you do operationally in your business differently, and that actually usually drives OPEX efficiencies as well as decarbonisation. What are some of the things that you have to pay a bit more attention to in terms of the payback period? They're a bit more capitally intense, and that requires a degree of rigour around it. At the moment, there is still a space for offsets as part of this discussion, and I think as we transition there is a place for offsets. It's a very big conversation which is probably worthy of another entire panel discussion in and of itself as about to what you mean by offsets and the quality of those offsets, and how we start to report on the quality of those. And I think all of those things are relevant things that the alternative investment industry can bring. I think finally it's a massive investment opportunity, investing in line with this thematic and this tailwind. We can all throw around those ridiculously eye-watering numbers of X trillion dollars of our investment are required over the next 20 years for us to reach the Paris goals. When you break that down, there are enormous opportunities across the investor landscape. Clearly, there's very large infrastructure investment opportunities, but there are also PE opportunities in this. And through the work we've been doing decarbonising our portfolio with climate risk, with one of our investments, Climate Friendly, who operates in this space, we're definitely seeing huge opportunities for both private equity and venture capital in this space to drive decarbonisation.
And I think, like, you know, today you already are seeing a green premium. You know, today it's becoming clearer the no-go zones of stranded assets. Coal is just one of those. It's a pretty big one, but the scope of what will be regarded as a stranded asset is continuing to grow. We see this coming out of Europe very strongly. You can see the favoured versus the far less favoured sectors, and understanding sort of where that direction of travel is clearly important, because we're talking about time horizons, certainly in our hold periods, right? And so, you know, I think that's a really important point, that we see, you know, people are making decisions now around these issues, and certainly it's a big pause for thought. We've rejected deals around assets that we just, you know, could not see the plan being presented by the GP that was well considered in terms of what's going, how that business was going to be moved forward. And we certainly did not want to be sitting with that asset down the track. But I think the important point I just also want to underscore is that, you know, we are talking here about moving businesses from brown to green. Right? We're not just talking about investing in businesses that were birthed green, and this is why the opportunity set is so big.
You mentioned coal then, so I might just play devil's advocate. What's the trade-off? Because, you know, we're seeing at the moment potential blackouts and brownouts in New South Wales and Queensland. So what's the trade-off of these kinds of controls?
Look, certainly I think it's a really difficult, and pointed moment in time. What we have seen certainly from LPs in Europe is that they haven't lifted their bans on investing into coal at this point in time. In fact, I think it has been turned into a very clear argument about why to accelerate deployment into alternative sources, obviously notably renewables, and an adaptation mechanism. So I think if anything, what we're seeing is that this is kick-starting that discussion, or accelerating that discussion.
Yeah, I would chime in on the trade-off point. It's really interesting when you look at the last sort of 10 or 15 years around all of the technology and efforts around decarbonization. The trade-offs used to be effectively cost and user experience, right? The climate-friendly version was more expensive or it was a worse experience. If you wanted a green car, you got, a Prius, which is not exactly the most fun thing to drive. And so that was the trade-off. What's interesting now is, we've been talking about decarbonization this whole time, but when you think about climate change, the whole point of decarbonization is to stop climate change. But reality is climate change is already here. We all see it. Every person in this room either reads about it on the news or maybe sees it outside your window with record storms, heat, drought, wildfire, floods. Australia had record temperatures earlier this year, record bushfires over the last couple years. And if you look somewhere like India, that just had, just a couple weeks ago, parts of India hit 50 degrees, temperatures. And one thing India does not have deep penetration rates of is air conditioning. And so when you think about the trade-offs now of how India deals with this, because these extreme heat's already here, and so the effects of climate change are already in their face, the way that they're going to deal with the heat is you have to add air conditioning. Air conditioning runs off electricity, and guess what? India's grid is not exactly very clean. And so all of a sudden, India is going to have to make trade-offs around, well, wait a second, do I decarbonize or do I say, I actually have to survive this heat? And so I need more air conditioning, which maybe brings me a step backwards in decarbonization before I can take a step forward. And so I think it's going to get into just this really interesting time where, we talked about the carbon budget in the beginning and trying to stick to this 1.5 degree pathway. And reality is it's going to be very hard to do that. It doesn't matter how much carbon we cut, it's very difficult to hit those numbers. And so these adaptation methods around extreme weather are going to become a lot more important. And these trade-offs are going to become more real in how we have to deal with those.
And not to go too far down that hole, but Greg raises the point about developed versus emerging countries. Some of the most difficult trade-offs are sitting with developing countries. We see that with our neighbors, right, with the Pacific Islands. So, this becomes a really interesting discussion in terms of the obligation, really a stewardship obligation from developed countries in terms of what aid and support gets provided.
I think it's also a really interesting point that Greg raised when you bring it back to an investment context is we do tend to spend a lot of our time talking about decarbonisation and talking about net zero and all of those things. That's actually only part of the climate risk and opportunity story here. Normally when you talk about climate risk, there's two categories of that. There's what we call transition risks, which are what are the risks as we transition to a low carbon economy, and that's where the decarbonisation piece fits. If you're not decarbonising and the rest of the economy is, that's going to have an impact. There are other aspects of transition risk, but it is probably the largest. There is this whole other bucket of risk called physical risks, which is what Greg was alluding to before. And equally, you need to be considering them in an investment context because actually, regardless of your short-term hold period, they're happening right now. And they're happening in terms of businesses are being flooded or people can't afford the insurance premiums that are going up. And so there are real-world impacts of that now. And if you're not looking at the physical risk inherent in some of your assets, and if you're not trying to manage that risk, that's equally part of this story alongside how are you decarbonising your business. And we had an example of a business that we looked at 12 to 18 months ago now that on a physical climate risk analysis actually would have ended up with stranded assets in a certain part of Australia, and so we passed on it. But had we not been looking at it with that physical climate risk lens, question mark, would that have come up as part of our investment decision? Putting the climate risk there firmly on the agenda does lead you to at least discuss different parameters of risk and return in these investments.
Yeah, I would jump in and just add, I think Natasha's point on the difference between physical risk and transition risk runs right smack into Suzanne's point on stranded assets, right? Because most people have thought about stranded assets generally from a transition risk perspective, right? If I own oil and gas assets, you know, and there's a carbon price, and eventually the world transitions away from oil and gas, that's transition risk, and it's a stranded asset. But reality is everyone owns infrastructure, and companies all have assets. And, you know, everyone in this crowd that are, you know, investors have an infrastructure somewhere in your portfolios. And, you know, 30 years from now, how many of those assets are in places where they will be flooded or they will be in storms that they're not experiencing right now? And so it's this whole other category of stranded asset risk that, you know, people really need to start thinking about.
Just perhaps back to the budget. Obviously, you've had plenty of time to think about this. Now, that might not be, for this crowd, it might be more policy to think about how long we've known about this and the time we have to have that transition be not such a steep curve. It was kind of a manageable curve 10 years ago. It's very steep now, and it's going to only increase steeper and steeper as we go. And that leads to that kind of shock transition where you're suddenly faced with these you know, lesser of two evils kind of choices to keep energy security to burn coal, for example. So as an industry, I would think that policy is extremely important here, and that private capital has a role to play in driving and advocating for policy changes, and also then being the private capital that through an informed process gets ahead of that and actually would benefit from that from those policy changes coming through and accelerating that decarbonisation.
Just mindful of time, does anyone have any questions in the audience at all? No good. I think the guys are still happy. Oh, yep, got a question.
Thanks. Just a question on setting priorities, because there's easy to abate, there's hard to abate, there's expensive to abate, there's abatement that pays for itself. So how do you sort of, when you first step into a portfolio company, how do you set those priorities in terms of what you're going to focus on, what you're going to measure, and then just extrapolating from that, what lessons have you learned that are kind of universals, where when you go into the second company, you go, these are the first things we're going to focus on. These might be electricity or LEDs or so on.
I'm happy to have a stab at that one first. So it's different portfolio company by portfolio company, but the approach is the same. And so certainly the way we've done it is to go in and say, right, the first thing you have to do is measure. So tick, you've got to do that first. Second thing you've got to do is look at what those sources are and sit down. It really involves, you've got to get really down and dirty with the operations people in these businesses, because they're the people that know the answer to this stuff. So we start with well, where do you think you can change things in your processes? Now that we know that this piece of equipment is more energy intense than that piece of equipment, can we switch that one off and turn that one on more, for example? And what are those kinds of things, and where do you save the money? The next one you go into is we work with consultants, and it's kind of like a shopping list of here's all the different things that you can pick from, and we've learnt pretty quickly that there's a bucket of easy to do, low-hanging fruit, a bucket of there's things that actually require you to sit there and financial model out whether it's financially feasible and whether there's a return on that investment and over what period, and that varies depending on location. In Australia, solar tends to have a better payback, in New Zealand not so much, and so it depends a little bit. So you've kind of got that shopping list of things that you can play around with. Procuring renewable energy or green power, for example, falls within that bucket of things that all the companies can look at. Most companies, particularly if they're manufacturing or industrial businesses, have a chunk of stuff that's just really hard at the moment. But having said that, we've learnt through doing this a couple of times now, there are 3, 4, 5 technology solutions that are coming online. They're just not financially feasible at the moment because the cost curve's not right, a little bit because there's not the policy environments for support for people to develop out those technologies. So what we've tried to do is develop a list of what are the things that you need to monitor, what numbers do you need to monitor where, as to where those points would cross over. And so that's a playbook without being a playbook of the approach that we've taken. The other thing that's really important is understanding with the business their business cycle, what cycle they plan their business on. So for example, the one we most recently did runs on a 3-year business planning cycle. So we looked at it in that tranche. You can't do everything in every business cycle. So let's prioritise so that you're getting a good spread of how much resource is going to be required internally to implement this, a good spread of how much increasing in your OPEX or how much CAPEX you're going to have to outlay, and how do you kind of smooth that through the business so the line's still heading in the right direction on the trajectory, but you're also managing it properly within the business. Does that answer your question?
If I may, like, another way to think about it is that you know what sectors these companies are in, and there's a lot known about the specific sectors that are problematic. So you're going to be able to very quickly tell whether you probably have an issue or not. And then it's about the nuance of that particular business to work out, well, what's specific about this one compared to its peers, and then you start to gather a little bit more information. And that could be, I mean, certainly an approach we advocate for is on that sort of risk basis to deal with those companies.
Well, we're out of time, so I'd just like to thank my panel, Natasha, Carl, Suzanne, and Greg. Thank you.